Okay, so money and monetary policy is the topic of the day. We are going to learn a lot. So, starting with what's money, what's not money, how it's measured, how banks create money, how the Federal Reserve System works, how we conduct monetary policy, how the money markets operate, and what's expansionary and contractionary monetary policy, and what the Fed actually did during the last recession. Okay, so let's go. So there are four functions of money: medium of exchange, unit of account, store of value, and the standard of deferred payments. So to be a good medium of exchange, money needs to be acceptable to a wide variety of um, trading parties in the form of payments for goods and services. So as a comparison, I have it here that potatoes or candy wraps are not acceptable. Unit of account. So the money allows a way of measuring value in a standard manner. So we cannot easily say, so how many potatoes it would take to buy a cup of coffee or to buy a pen or pencils or a house. So how many potatoes does it take to buy a house? So potatoes is not a good unit of account. Store of value. So money allows people to defer their consumption till a later date, and potatoes would not be able to do it as easily, right? Because they are perishable good. A standard of deferred payment is somewhat similar. So money facilitates exchanges across time when we anticipate that its value uh, will be predictable in the future. So whereas for things like paintings, like Van Gogh paintings, or even the same old potatoes, the value is less predictable for the future. So uh, based on those functions of money, we can actually um, try to figure out, so what can serve as money, because you can issue your own money, and Bitcoin is kind of working like money too. It's being acceptable universally, not yet universally, but in many places, in some places at least, as a medium of exchange. So to issue your own money, you need to make sure, so once you issue your own money, that they are acceptable to most people. So that's probably the challenging part of it. How do you make it acceptable to most people? Maybe you make them really cute, so you draw a good picture, right? So will that work or not? So another thing that should happen is that they need to be of standardized quality, so they all need to look alike. So all Bitcoins look alike, right? They sort of do. They don't even have a physical shape. Okay, so the object should be durable so that the value is not lost by wearing out or by getting perished. So yeah, Bitcoins don't get perished unless you lose your account and forget your passwords, right? So another condition is that the object needs to be valuable relative to its weight. So you can carry it, easily transport it in large quantities, right? So there's nothing easier than transport a Bitcoin in large quantities. So it weighs nothing, zero. So it needs to be divisible enough to be used for purchases of both low price and high priced goods. So if I want to buy a smartphone, how many Bitcoins would it take? So here's what is a problem, right? So Bitcoin is not as divisible as money. Therefore, it probably is not going to replace money so easily. But it's a good store of value. So many people believe that it's not going to lose value, but it's not as predictable either. Right? Its value jumps too much. So yet Bitcoin and the money that you have on your account with PayPal, with Venmo, and even airline miles, all these things have characteristics of money. right? Although PayPal and Venmo mostly serve as a means of payment, right? Not as something that generates its own money, unless they somehow add points to your account and then monetize the points. So they are just basically a means to pay. So officially, what's money is checkable deposits and cash. Checking account and cash, and in some measures of money also your savings account. So when we talk about money, that's what we mean. So basically debit cards, cash, and not much else. There used to be traveler's checks, right? Those things are in the past. What's not money technically is credit cards. So we don't make a distinction on a day-to-day basis, but credit card is technically a short-term loan. So it's not money, so it's not counted as money supply of the country. Or government bonds or stocks, things like that are not money. They're alternative assets that you can hold to better preserve value. Money has some very valuable features, so like they're liquid, they're anonymous, but they also have a drawback. Main drawback is they don't pay interest and they lose value to inflation as well, right? That's what the drawbacks are of holding money. Okay, so brief history. So before there was money, there was barter. So primitive people didn't have money, they bartered, they traded. But the problem with trading, what if we return to trading? If we abandon money, return to trading, then there would need to be double coincidence of ones for each trade. Say I'm selling economics lessons and I need milk. So I'll have to find somebody who has milk and who needs an economic lesson right now. So you see a problem, there will be a lot of effort wasted. So if credit cards aren't money, does that mean spending on credit card does not count towards GDP? Oh no. It's that does not mean that. Okay, so money is very remotely related to GDP. Okay, so there's no relationship really, strict relationship between the amount of money out there and GDP. There is a little bit of relationship, and I can return to that as I explain more how everything works in terms of aggregate demand and supply. But yeah, don't worry, you're absolutely supporting the economy by spending on credit cards. Yeah, it is withdrawn from your bank account eventually anyway, and it ends up in somebody else's pocket. So you're absolutely sponsoring the economy, no matter how you pay. Okay, so after barter, actually, I'd say I must mention that in some countries where local currency it just stops working, and that happened in the past on like a few occasions, that let's say a government is particularly responsible and lets a hyperinflation happen, and so people kind of almost abandon their currency, their local currency, and they accepted dollar as payments, and they also resort to barter. So they would come to the doctor's office and bring a jar of pickles that they made at home, right, as a payment, or something of that sort. So I saw that in after the collapse of the Soviet Union. That's exactly what happened in Russia and Ukraine and other republics. So for a while, local money were so devalued that people bartered quite a bit. Okay, so after the barter system, there were commodity money. So the first money that the humankind invented were some shells, cowrie shells. Then there were pieces of precious metal, so gold coins, silver coins. So some societies use animal pelts, and that was in colonial America. And then in some closed systems like prisons, they use either cigarettes, and I also learned based on Orange is the New Black, that flavor packs of ramen noodles can also be used as a unit of exchange, of a unit of account and a medium of exchange. So commodity money have intrinsic value, so you can do something else with that object, whereas paper money don't have intrinsic value. So, but the first paper money were exchangeable for gold or even silver sometimes, but mostly gold. So they were supported by the government promise to exchange the value of this piece of paper into a certain number of ounces of gold. So, but that's no longer the case. No currency in the world is currently exchangeable for gold. So we have moved away from the gold standard because it's much easier to conduct your monetary policy when you can easily issue as much money as you desire. So modern money are called fiat money, just pieces of paper that are intrinsically useless and supported by the government and government's promise not to devalue the value of that piece of paper. Okay, so and as long as people believe they're valuable, there is nothing wrong. They will be in circulation. So once people stop believing them, you have a problem. And especially U.S. would have a problem, and because most of the cash that's issued in the U.S. by our central bank, which is called the Federal Reserve, is actually not even kept in the U.S. It's kept abroad by foreign nationals, by people all over the world who live in higher inflation countries, and they want to preserve the value of their well-deserved paychecks. Okay, so money supply is technically measured by what's called M1 and M2. There's also M3, which is rarely used. So we're just going to focus on M1 and M2. So M1, and we have about almost close to 4 billion of money that are called M1. So checking accounts and currency. So lump them all together. See, the larger share of it is checking account. So if you sum up the value of all the checking accounts in the US and the value of all the currencies, especially look at this cute $2 bill, my favorite bill. So then we'll arrive at that number that's close to $4 billion. So if you take M1 and then add something to it, something in particular savings account, money market mutual fund account, and small denomination time deposits. So there used to be a lot of these things that the different banks offer. They're probably still offering. Yeah, people do have savings accounts. So savings account and money market mutual fund shares, they're pretty liquid too. So there might be some restrictions in terms of withdrawal, then these accounts also pay a small interest. So M1 does not usually pay interest, although some checking accounts now try to pay interest. And M1 is about, see, look at this green green share like slice. It's about a quarter of M2. So M1 is included into M2. So this is the measure of money supply. So thinking about money, we're going to be thinking M1, perhaps. Let's for simplicity, let's think of M1 when we say money. Okay, so banks. What do banks do, why they're created, and how do they create money in turn? So banks are important. Why? Because there should be an institution that takes money from savers, you and me, and others, many thousands and millions of other small potential savers, and channel the money to potential investors. So those who need funds. So we as savers don't need our funds for a while. And we are more than pleased to be compensated for our trouble of lending our money to investors. But for us to invest directly into companies, well, we can buy stocks, right? So that's one way of directly investing into companies. But how much do we really know about the companies that we're investing? So take Coursera, right? So do you really, like, we know about, it's a good company, it offers free courses, we can go to Coursera.org, but how are we sure of how financially sound the company is? How much are we sure that his business model is not going to be disrupted by somebody else, by a new entrant tomorrow, right? So we are not doing all that research. So when I buy one share of Apple, I'm not really looking at the financial statements of Apple, right? So I'm just kind of hoping that since Apple is so powerful in the current markets, right, that its operating system will survive the toughest competition, right? So, and what about all the small businesses that are out there? We're not checking their financial statements before buying their stock. Whereas companies do what, like companies like banks and financial intermediaries do when they lend to large and small corporations and pop and mom businesses. They do um, they do assess the risk of their investments, and that's why we do need financial intermediaries. Another difference is that firms need a large sums of investment. So when they borrow large sums. When we save, each one of us, we save very small amounts. So financial intermediaries take our little tiny bitty savings and combine them in large chunks and lend them out to investors. So they reduce risks for us in terms of diversification. So they do their due diligence and invest into a large number of projects. And the returns are always risky, but they're the ones who bear the risk of default. And our savings are most often insured. So nowadays there are this new age financial intermediaries that also kind of look like banks, almost act like banks, not quite. Peer-to-peer lending sites, the crowdfunding sites, although crowdfunding is not like an intermediary. But so let's say they're examples of Lending Club and Freedom Plus, assuming .com. So they earn flat fees for facilitating a loan, then they charge fees for collecting payments, but take none of the risk of the loan defaulting. So I guess people who lend are the ones who bear the risks. So on there's some evidence that there are more risky projects on this, because they're facilitated through this kind of investment opportunities. Okay, so let's look at, even if you're not an accountant, this is not an exercise in accounting, but we're gonna look at, so what is it that the banks do when they take your deposits? And that's their main business, right? They're gonna take your deposits, as this bank has on the right-hand side of the balance sheet. So liabilities and stockholders' equity. So liabilities is the money that the bank owes to you and me and other depositors. And so they took $1,000, probably $1,000 billion, right? So that's like a trillion. Really is a very large bank, right? But let's call it 1,000. So in deposits. And what else does it have on the liability side, on the right hand side? Short-term borrowing. So the bank can borrow from another bank. It can also borrow from the Federal Reserve, but the Federal Reserve is like a mommy or a daddy, like a parent. You don't want to borrow from your parent, you want to borrow from your brother, right? So you borrow from another bank. There is long-term debt too, so you can borrow long-term if needed, and some other liabilities. And then our accountants would know what that means, but what we do want to also see is that there's something on the left-hand side. So on the left-hand side are banks' assets. So the money that the allocation of their money, right? The money, things that they own themselves. So they took the deposits, they borrowed from other banks and took out some long-term debts and other liabilities, and they invested all that into like buildings and equipment, into loans. They gave out loans to businesses and moms and pops and mortgage holders. And they also bought some securities because there's not always an opportunity to find a good borrower, so to give out a loan. So they can invest. You don't want your money to sit on your account without being invested, because if it sits as just money, as extra reserves, then you're not earning any interest on it. So what do we mean by securities? Security, usually banks don't buy stocks. They're not allowed to buy stocks. Unless they're investment banks. This is a commercial bank we're looking at. So securities are government bonds. So government bonds are risk-free securities and they pay a little interest. So that's what banks do with their excess funds. So reserves. What are reserves? So from every deposit, and it's actually in real life, it's on each deposit above a certain amount, right? But let's think about it being just 10% from all deposits. That amount needs to be kept on reserve. So in this example, the amount of deposits is 1,000, all right? So if 10% has to be kept on reserve, then how much required reserves should there be on this balance sheet? 100, right? $100 instead of 135. So the 35 is actually extra reserves. So the bank is holding some extra reserves, and there may be reasons why they're holding on to extra reserves. They may not have good securities, good loans, opportunities, or they may be getting some interest on reserves. That's like one of the innovations that the Fed introduced lately. They're actually paying banks a bit interest on reserves. So reserves is something that a bank holds at the Fed. So reserves is like you're holding your deposit in the banks are holding their deposits in the Fed, and they call them reserves. So it's like the Fed is like a banker's bank. So you and I, we can't have an account in the Fed, but only the banks can have it. So, and that's what the reserves are. They're the amount of money, the deposits that each bank has to hold at the Fed. Okay, so fractional reserve system refers to just that. So a fraction of all deposit needs to be, of each deposit, no new deposits daily, needs to be held on reserves. So let's consider it to be 10% in most examples. We'll use that number. So now let's see at which point new money is created and new money is destroyed, and how the MR1 can change when a bank issues a loan. So you bring $1,000 and deposit it at Bank of America. So immediately it's like an accounting system works the way that um, double accounting, right? So your deposit becomes a liability, and build also is recorded on the asset side as extra reserves, right? From these extra reserves, 10% has to be kept on required reserves, but the other 90%, you can do anything you want with the 90%. You can invest it into treasury bills, treasury bonds, or you can lend it out. And that's what the bank prefers to do. It issues a loan in the amount of $900. So now, how does it issue a loan? It credits somebody else's account. So a small business mom and pop asked for a loan of $900. So the bank said, yeah, Johnny just brought us, or Rudy just brought us $1,000, right? And so a loan is issued to pop and mom business in the amount of $900 because they have to keep the $100 on reserve, remember? Okay, so mom and pop goes out and say, yay, great, we can buy ourselves a new pizza oven because we own a pizza shop. And so Bank of America, so they increase, they withdraw their deposits from Bank of America in the amount of $900, and they make a payment to the place that makes pizza ovens, $900 pizza ovens. So like a pizza oven store. And the pizza oven store has an account at PNC Bank. So they bring the check. Remember the checks? We used checks in the past, right? Yeah, remember those. So we'll suppose they got paid by check, right? But even if they weren't paid by check, they still end up with the $900 extra that will end up on their bank account in an ideal world, right? Speaking of everybody depositing their profits right away. So in that sense, we're talking about an ideal world. But let's think about this happening over time. So now we have $900 extra walking around, which was created based on your $1,000 deposit. So had you not made this deposit, this loan would not have been possible, right? So we have this new money created, $900. Okay, but PNC Bank is also in the for-profit kind of business, right? So they want to make money on this new deposit that they just received. They can do the same thing. They can keep 10% on reserve, and they can lend out, so it's $90 on reserve, and they can lend out $810, right? To, let's say, Brian. Brian wants a new super chainsaw, right, for his business. And so Brian is borrowing from PNC Bank, right? So what happens is that they accredit his account, and they the amount of deposits increase, and the amount of loans outstanding also increase, and the chain store ends up with $810. And then the fourth bank and the fifth bank in this transaction. So if at every stage of this process, if everybody's borrowing exactly 90% of the money that was previously deposited, and if everybody's spending it right away like robots, and if you spend it and the other business deposited right away, then we end up with extra many rounds of extra money creation, right, to zero, like speaking 2 cents, right? If we count all of that, that ends up being the total of, so the new money created was in the amount of $9,000, and then the old money was 1,000, so the total $10,000. And now you have a sense of what a multiplier is, right? So that's exactly the case for the multiplier. So the money multiplied 10 times. And you can even compute it by dividing the taking the reciprocal of the reserve ratio. So that's $10,000 to find, so how much total money was created by a $10,000 deposit. You take $10,000 and then multiply it by 1 over 0.1, which is the required reserve ratio, and we end up with 10,000. So, but this is just a fairy tale. The economy is not that perfect. So things that are the amount of money, the projects that are borrowed for, not always take place, or maybe there are delays involved in the project, and maybe not all cash is spent that is borrowed, not spent right away. So they're in the real world, economists have been curious. So what is the real world multiplier? And it turns out that every time they try to estimate it, they come up with a number below 2 most of the time. So the money is multiplied, but not as much, not nearly as much as the theory suggests based on the required reserve ratio. And sometimes people borrow and save, not spend, right? So for many reasons this happens. And they even noticed that during a bad recession like the one in 2008, the multiplier was 0.9, so it was less than 1. So people were saving more, way more than they were spending. Okay. Bad things that can happen when you put your money in the bank. So starting with bad news, right? So on the bad things that we're about to explain are called bank runs and bank panics. And they're very much less likely nowadays than they used to be. And they used to be back in the beginning of the 20th century or even earlier. So 150 years ago, they were kind of a common thing. So there was some kind of bad news that the bank is not, something is going on with the bank assets because of maybe bad economy, bad crops, or some risky investment that the bank made. And so depositors run to withdraw their cash. They are not finding all their cash, or maybe not all depositors are able to withdraw it. And then a panic starts, and other banks or depositors at other banks also run to withdraw their cash. And then the entire banking system can collapse. So one after another, it's called contagion. Banks can fail. So there needs to be some oversight. There needs to be some insurance. And with that in mind, the Federal Reserve System, which is the central bank of the United States, was created back in 1914. So over 100 years ago. And can you imagine, the humankind is much older than 100 years old. They've all that time, humans lived without deposit insurance. And it wasn't even until 1934, so less than 90 years ago, that you could put your money in the bank and not worry about the bank collapse, right? So, which is a big thing, big deal. And without federal deposit insurance, there would be a lot more people putting their money into their mattress. Yes, I heard the story on the news that some nice daughter cleaned out her mom's apartment while her mom was in the hospital, right? I think that was the story. And then she threw out the old mattress, and that's where her mom kept like $1 million, something like that. Oh, so yes, just like those people who forget their Bitcoin passwords. Yeah, not happy. All right. So originally the Federal Reserve was created to issue discount loans to banks that are in trouble. So we can discount loans can quickly resolve bank runs, right? So you can repay your depositors and stop a bank panic. But over time, the Fed's role has changed. So discount loans is it is still a role. It's still an important part of what the Fed is doing, but not the most important part. So the Federal Reserve System, usually a different country would have only one central bank. The US is special. We have about 12 of them, exactly 12 in fact. And that's probably because in many other countries there's only 2 or 3 main banks. In the US there are about 4,000, different banks and thrift institutions, and they're all regulated by the Fed. So they report to their regional Fed. So, and the Fed is in charge of monetary policy, and there is this important committee within the Fed called Federal Open Market Committee. So they conduct what's called open market operations. I'll tell you in a bit about what that means. And the chairman of the Board of Governors of the Fed now is Jerome Powell, and it used to be Janet Jackson. Janet Jackson Yellen. Janet Yellen. So I even shook her hand 2 years ago. She's like a little, tiny little woman, and I was very powerful in monetary policy. Okay, so
did she have a Spider-Man costume on?
Did she have a Spider-Man costume? It was at the American Economic Association meetings. Yeah, she probably should have had one. Very impressive woman. Okay, and she's now in the role of the Treasury Secretary of Treasury in the government. Okay. Other roles of okay, yeah. So besides giving out, being the lender of the last resort, other roles of the Fed is to conduct monetary policy in such a way to promote the agendas, with the goal number one being price stability. So high employment is also a goal. Stability of financial market is another important goal, and economic growth is kind of the last one on this list. So price stability, let's see how we are doing in terms of price stability. So looking from 70 years ago, so that was not at the time the Fed was created, but it was kind of quite like 20 years after the deposit insurance was introduced, and almost 40 years after the Fed was created, right? So the prices spiked pretty much just kind of out of control only once. That was in the 70s, right? So, and in the early 80s, they were already under control. And at that time, Paul Volcker was the Fed chairman. He was the one, I guess whoever was before Volcker was less responsible. And he's credited for bringing inflation under control with his particularly tight monetary policy. And when we're going to be using the word tight with regard to monetary policy, will mean high interest rates. So loose policy means low interest rates. Tight means high interest rates. Okay, so price stability, we're doing really well. Since the 80s, prices have been going up every year, but by no more than 2%, 3%, and than that usually, just pretty good. And the same thing happens in Europe. So European central banks are also pretty tight on inflation. They even target inflation. So in the US, we don't have a target of inflation. So we never really announced that, okay, well, we want the inflation to be 2% and we're going to stick to that. So no, that's never the policy, although maybe unofficially the Fed is looking and always comparing, saying, okay, well, if we are higher than 2%, then we need to do something about it. And usually doing something about it means tightening interest rates, so bringing them higher so that there's less of overheating in the economy. So prices rise when the economy is doing quite well, as we've seen, all right? So the aggregate demand shoots out too long, right? So the prices increase. And so, yeah, and it hasn't happened. And I'm sure, yeah, we should be concerned, just like Rudy is concerned, that prices may end up going up, but not right away, about over time, probably over time. Okay, now we're going to look at the most important tools of monetary policy. There are about 4 of them, or 4 or 5. So we're going to look at them. The most important is number 1. So pretty much all monetary policy is done through the tool that's called open market operations. But then there's also discount rates, reserve requirements, and interest on reserves. So let's see how that main tool works, the open market operations. So, and what it means, so operations is not a surgery in this case. It is just buying and selling of treasury bonds by the Federal Reserve in order to control money supply. So if you remember that a typical bank has securities and loans and reserves on the left-hand side, on their asset side of their balance sheet. So here it is represented using the T account of the banking system. So we have treasury bills and we have reserves. And when the Fed makes a trade, so they are offering, they're buying, so they increase the money supply. The Fed directs its trading desk in New York to conduct an open market purchase of U.S. Treasury securities. So bills, notes, and bonds, which are short-term, medium-term, or long-term, so up to 30-year bonds, tradable loans to the U.S. Treasury. So they are open market purchase. They're selling. They are a trading desk. They go out and buy some treasury bonds from banks. Banks are holding treasury bonds, and so they're offering a slightly higher price for the treasury bonds, and the banks are like, yay, we're gonna sell. Of course, the price is really good today. And so they sell. And how this happens is they say, okay, well, we're gonna buy. They're gonna sell treasury bills, right? So they can say, we're gonna sell $10 million of treasury bills, and so in exchange they receive $10 million on their reserves. So maybe Bank 1 receives 1 million, Bank 2 receives another million, Bank 3 another million, right? So it's spread all over the banking system. And now they have more money on reserves and less money tied into treasury bills. And once you have more money on reserves, you can go out and lend out the money. You cannot lend out treasury bills, but you can lend out reserves. So you suddenly have more excess reserves and you go, yay, we're going to find some borrowers and lend the monies and make some interest on the deal. Right? So once you start lending, that multiplier effect can kick in, right? So there's more money in circulation all of a sudden, but not much more, right? Not 10 times more, like 2 times more maybe. And but the fact remains the fact that we have more money floating around, fewer treasury bonds, at least for a while, right? So more money is created temporarily, and then But the transaction happens, so people buy and sell goods and services in exchange for pieces of paper, so we know. And so that spurs economic activity. And then if you want to do the opposite, if you're saying, oh, there's too much economic activity going on out there, what a danger of inflation, so you're going to say, oh, you'll call your trading desk in New York and say, hey, we need to remove some money from circulation. We need to remove some, right? So what do? We're going to sell them banks treasury bonds instead. So, and then they offer them a good price and the banks buy the treasury bonds. So, and there's suddenly less money on reserves, so they cannot make as many loans as before. So these kind of open market operations can happen any time of the day. They can be reversed, right? So if too much was bought, they can sell instead. So it is very flexible. Also notice that last time we talked about fiscal policy, we noticed that the government issues a lot of debt in the form of treasury bonds and bills, but some of the debt is held by the government system, and that's what it's being used for. So it's very much actively used in conducting monetary policy through open market operations. So what would we do without treasury bonds, right? I don't know. Life would have been much harder for the banking system. Okay, if it wasn't for the treasury bonds, then the banking system or the Federal Reserve would have to use their other tools, specifically discount rate and reserve requirements. So discount rate is the rate at which the Fed can lend to the banks on an overnight basis. So it's very low interest rate at which the Fed can provide emergency loans to the banks. Yet the banks don't usually go to borrow from the Fed. They borrow from each other at what's called the federal funds rate. So that's the rate at which the banks borrow overnight. Let's say suddenly you have a good borrower, but you don't have enough reserves, so you borrow from a different bank. So there's this whole system set up for the banks to get a little bit of interest, at least overnight, on a short-term basis. In fact, so the discount rate is not used pretty much at all, very rarely, maybe only in super emergency, like the financial crisis of 2008. During that time, some discount lending was provided, but for banks to ask the Fed for a discount loan means they'll be audited. They don't want to be audited. So it is kind of a tool that exists in name, but in real life, the Federal Reserve, when they set the target rate, they don't call it discount rate. They don't even pretend. They saying that we are setting the target for the federal funds rate. So that's how it's all announced usually. We're setting the target for the federal funds rate at, let's say, 2%. Or we are increasing the target for federal funds rate by 0.25 to 2.25%. So if the Fed decides to increase the interest rates, that's how they announce it. So they kind of announce it as if they increase the discount rate, but they more often refer to the target for the federal funds rate, and they're pretty good at it. So they conduct in their open market operations to be consistent with what they announce. So they want the federal funds rate to go up, they will. So they will make money more scarce, right? So everything that's more scarce, as we economists understand is more expensive. So anything that's more plentiful, including money, is cheaper, right? So when I reduce interest rate, you make the money more abundant and available. So you will buy government bonds and increase reserves for the banks, and then that will reduce interest rates. Okay, so reserve requirement as another tool. You can technically make the money more plentiful by reducing reserve requirements, right? So by asking to keep only 9% or only 8% on reserve instead of the required 10%, okay? Or you can do the opposite. You can demand 20% money to be kept on reserve. That'll make the money more scarce, right? So banks will be able to lend less. So this tool is never really used. It's like a sledgehammer tool. And why would you use it if you have open market operations? A very sneaky and available tool. Here, this is a picture that shows how the federal funds, right? So it shows the actual amount of federal funds, the actual rate, federal funds rate that the Fed sets, and it controls it well. Say during the financial crisis, the target was pretty much 0 or 0.25, and it was 0.25. So it pushes federal funds rate down during recessions, yes, to encourage high employment, and up during expansion to encourage price stability, yes. And also notice in that picture how during high inflation, the federal funds rate was high as a way to reduce the inflation. Nowadays, there are additional tools that the Fed is using. So as an innovation, they're paying interest on reserves for banks if they want banks to encourage to hold more money on reserves. So, and this other tool is more sophisticated, and there are some repurchase agreements that they have with banks and even with investment banks and regular banks. So repurchase agreements, and we're not going to go into that, but it's an extra way to conduct monetary policy nowadays, so as sophisticated as we are getting. And it's not even all economics books include the new tools. We'll discuss them in a minute. Okay, so now we're going to show you that so when we say monetary policy, well, we're talking about money supply or interest rates. And so we're about to make the following point is that when we say money supply, we mean interest rate, because when money supply is high, interest rates tend to be low. And when money supply is low, the interest rates tend to be high. So it's one and the same thing, really. And here is why. So the demand for money. So let's think about the market for money in the short run. I think we looked at a similar picture last time. Well, let's just repeat it one more time. So money is one of the assets out there, and so we as individuals, then there are firms and there are banks, all of us hold some amount of money, right? So when the interest rates on money don't pay interest, as you know, but other assets do. So when interest rates are higher, then we want to hold less money, so less of our wealth in money, and so do firms. So they're more careful about not holding large sums of money when the interest rates tend to be higher. And when the interest rates tend to be lower, then we care a little less. So that's why the demand for money is a downward sloping curve. So, and the demand for money can go, it can shift left and right, so it can decrease or increase depending on the state of the economy. Okay, so when the Fed increases money supply, so and money supply is not dependent on the interest rate, it's just determined by the Fed, so that the money supply will be 3.5 or 3.6 trillion dollars. Remember, we're talking about M1. That's about 3.5 or 3.6 billion dollars. And so if the Fed wants to increase the money supply, they will make their open market operations. What do? They're gonna buy bonds away from the banks, right, in exchange for money, so that banks could lend out more, right? So that will increase the money supply in the economy, and as a result, interest rates will go down, right? So by increasing money supply, we are reducing interest rates, okay? So by using kind of one outcome, or by affecting one outcome, we're affecting the other. All right, so we can say the other way, we can say that if we want to reduce interest rates, we need to increase money supply. So same thing. We can also decrease money supply, right? So we can sell treasury bonds to the banks and consumers and firms, and we can take money away from the economy, right? So let them hold the bonds, hold pieces of papers, you can't lend them out, right? And that will reduce money supply, and the interest rates as a result will be higher, right? So federal funds rate and all the other rates as a result, right? Because interest rates kind of all connected. When the discount rate or this federal funds rate goes higher, then it becomes more expensive for the banks to borrow. Therefore, they're going to charge a higher rate for their mortgages, for their to their best customers and even to their worst customers, the riskiest customers, right? Everyone along the way will feel the increase in interest rates. Therefore, there will be less investment going on, as you remember, right? High interest rates discourage consumption, investment, and overall reduce aggregate demand. And we're about to show that, just that. So this is an example of the monetary policy that we all like. It's called expansionary, also called loose or easy monetary policy. And that involves reducing interest rates. So when interest rates become lower, so the open market operations are conducted in such a way that to make interest rates lower. Okay, so what do you do with every time you kind of need to like imagine that while you're buying or selling treasury bonds. Okay, so you want to have more money in circulation, right? With lower interest rate, that means more money. So you're buying the bonds in exchange for money. So you're giving the system more money, right? So now lower interest rates means higher consumption, higher investment, and even higher export. Because U.S. Lower interest rates will attract fewer foreign investments and therefore will not put pressure on the dollar to appreciate. So more like even a little bit depreciate, which is good for the exports. So all components, except probably government spending, is independent, more like determined by the Congress. So it is our aggregate demand will shift to the right. So if you're in a recession at point A, it is pretty good. It's a good deal, right? That the monetary policy can shift the economy back to point B, to its long run aggregate supply, and to its perfectly comfortable level of output and employment, right? With a little bit higher prices, which is usually not a problem at first. But if you keep going and going and your aggregate demand grows higher beyond its long run aggregate supply curve, as it is on this new picture, then contractionary or tight monetary policy may be in order. So you want to reduce aggregate demand from point A to point B on this picture. So, or maybe you're concerned about possible inflation, so you're doing that with price stability in mind, and so you increase interest rates. So you do the opposite of the open market operation that you did before. You are actually selling government bonds at a good price, good enough for people to buy them, and therefore the interest rates will go up. Yes. So this is an example of contractionary monetary policy conducted by the Fed before the previous recession. So in 2005, the Fed decided that they need to increase interest rates. Well, because, let's see, long run aggregate demand, aggregate supply, is going up, right? So the orange line to yellow line, it was estimated that the economy is growing. We should be producing more. Yet, the aggregate demand is growing way too fast to outpace what's comfortable. So instead of, um, we are projected, well, the Fed was projecting that we're going to end up at point B, where the prices are higher than they should be, and the output is higher than we need to have. So the policy was to reduce aggregate demand by increasing interest rates, which they did, and for potentially perhaps prevented inflation for a while, but kind of neglected other possible problems like the housing bubble or the securitization of mortgages, right? Or the unruly investment bank activities, right? Or too much. You can argue about inflation and not enough about controlling the bank behavior. Okay, so one drawback for monetary policy is the same as it is for fiscal policy, and specifically that it takes time to implement. And in this example, you are trying monetary policy when it is too late. So you're kind of magnifying the next business cycle for no reason by keeping the interest rates too low, responding to previous recession, but the recession is over. And so, yes, you can be late just like fiscal policy. But nowadays, economic indicators are better. Yet economists is just as terrible as predicting inflations, right? As you may have heard the joke that economists have successfully predicted 15 out of the last 8 recessions. They're just that good. So another drawback is that the estimates are changing. In this one is giving you an example is that the estimates of GDP have been continuously revised down. So GDP of 2008 during the recession, the estimates were optimistic as if GDP is growing, and then years later, even 10 years later, that was when the last revision of the GDP took place. So I guess, and it's hard to calculate everything, to add up all the goods and services and their market value, right? And then do not forget to double count, right, all the inputs into production and some things not to count, things that are produced in a different year, and all the informal transactions and all that, right? It's hard when you do it on a massive scale. Okay, so some of the policies that took place during the last recession is what's called quantitative easing. The federal funds rates were already very low, and yet the banks were still in trouble and not lending money, not able to find good borrowers, so being more careful after years of lending, subprime mortgages, right? Then and firms were careful, uh, were reluctant to borrow funds. So what is it? Total bank reserves. So the amount of reserves in the banking system increased tremendously, and they're still staying pretty high. So before the recession, the banks were unwilling to hold much reserves, right? So the amount was close to zero. Now it's positive. Well, to some extent, it's explained by the reserves now bearing interest, right? So that's why there's so much money on reserve, but maybe just not enough good potential investment opportunities. Who knows? So this graph shows how the balance sheet of the Federal Reserve changed after the financial crisis, or during the financial crisis. So in the past, there were some U.S. Treasury securities and some other assets, including buildings and all that. Sorry about that. That's my mom from Florida. I'll talk to her later. Then during the crisis, the Fed has bought a lot of private securities, so mortgage-backed securities. See, there is a red area, purple area. So mortgage-backed security is something that has never bought before, and this was part of the quantitative easing policy. So discount loans. So these are QE1, QE2, and QE3. So they're like the stages of buying this mortgage-backed security. The first stage, the second stage, and the third stage. So in each stage they piled up more and more. And that was to help troubled banks, like banks that accumulated too much of mortgage-backed securities. Sometimes there's changes in the banking system or in the financial system that took place in the 90s through the 2000s. It's called the development of the shadow banking system, because many firms acted like financial intermediaries, but they were not. They say they were not FDIC insured specifically. So investment banks like Bear Stearns and Lehman Brothers, and then there are other money market mutual funds and large and small hedge funds. So they accepted a lot of deposits from people like you and me. I know someone who lives in my area who had over $500,000, so about $600,000, and he's just an electrician in the area here. And he and his wife, they're 80 years old, had all of their life savings in Lehman Brothers, and they lost it all. So now count your blessings, right? that you have not lost that much, right? So, but they survived, although he briefly considered not living any longer. I know that what happened next. So the firms, yes, the deposits are not insured and they're highly leveraged. So the firms are highly leveraged, means they are borrowing funds and investing. These are some of the actions that the Federal Reserve took in order to help the economy during the financial crisis, right? So that includes restoration. Okay, so discount loans to commercial banks, and not only to commercial banks, but also to companies. So never before did the Fed lend to companies directly of the purchase of mortgage-backed securities, another big deal. Then the Fed helped JP Morgan, Chase acquire Bear Stearns, and then there were deals with Fannie Mae and Freddie Mac, the government but sort of privately owned corporations that sold mortgages. Then there or other actions that the Fed took. And the interesting part of all this is that it is not always clear, at least not clear to me, whether what's going on is monetary policy or fiscal policy, because some of it involved Congress, right? Congress does fiscal policy, where the Fed, on the behalf of our central bank, is independent of the government, is sort of a branch of the government, but also not the branch of the government. They are doing their own thing, right? The monetary and fiscal policy are two separate policies, and the chairman of the Fed is elected in such a way to not be reporting to any particular president. Okay, elected, appointed, really. So, but for a term much longer than a presidential term. Yeah, so, but let's just divide it this way. Whatever originates from the Fed is monetary policy. Whatever originates from Congress is fiscal policy. So this TARP, Troubled Asset Relief Program, that so troubles the banking system, led Congress to pause the Troubled Asset Relief Program, providing funds to banks in exchange for stock, right? So that is kind of like a weird fiscal policy that looks like monetary policy, because like financial deals are being done with banks, right? Okay, so that's the story of today. So yes, notice that the Fed was rescuing large corporations and financial intermediaries, whereas in the most recent crisis of last year, um, it's more like the consumers were rescued. And even interesting part to me is that we are actually this year, last year, experimenting with basic income. So something that is fascinating as an idea. Should we be introducing basic income, some basic income to everybody, whether you work or not? And let's see how it works, see what people will do with the money, and maybe it is a successful policy. So that's the last slide that summarizes how contractionary and expansionary monetary policy works based on the graphs that we saw. So we have an open market operation, followed by with the money supply that increases or decreases, and the interest rates change, and then we have response from consumption, investment, net exports, and then we have the response to the aggregate and from the aggregate demand curve overall, and we see the results in the real GDP. employment level and the price level. Okay, that's the story of monetary policy. Any questions?